Welcome to the Real Estate Explainer podcast, where we talk about anything and everything real estate. I'm your host, Brian Kiczula. Take notes. Today I've got Tilden on the podcast, and we're going to be talking about raising capital to buy real estate, specifically Regulation D offering. Can you tell the listeners, what is a Regulation D offering?
The Securities Act of 1933, which is the main act that covers securities, says that everything that's a security has to be registered with the SEC, except if there is an exemption. And so Regulation D is really the most commonly used exemption. It's about 95% of all private offerings go through Regulation D. So it's a set of rules that allows people to put together a security, sell that security, and not have to go through the extraordinary expense of registration, which is tons of attorneys and tons of dollars.
When you're talking about raising capital to buy real estate, why are we talking about securities? Most clients that I work with we just think joint ventures. We'll set up a joint venture and buy the property together. What's the real difference between the Regulation D offering and a joint venture?
A lot of times, those joint ventures really are securities, and it's missed. So it's something that people don't know about. So a security is, people can think of it primarily, the large umbrella is an investment contract. So, which is really defined as any time there is a common venture that's put into where somebody is contributing their money and they're expecting profit back. And really, they're relying on someone else in order to do the work. So in this case, the sponsor or the syndicator, then that's a security. And so the security needs to either be registered or fall under that kind of an exemption.
All right. So I'm coming in, we're buying, let's say, a mobile home park. So we're buying the park together. You come to me and say, hey, I've got this great real estate deal. Do you want to invest? I say, sure, I'll invest $100,000, but I'm not going in as an active partner. I'm not managing the day-to-day operations. I'm literally just writing you a check and I'm expecting a return on my income.
Exactly. And it can be even more things than that. And so a lot of people think that either they're putting it into a joint venture and so they'll all be named there, but there's a wink that I'm going to make all the decisions and you don't have to do anything. That's a security. It could be, even the other day I talked to somebody who was going to be borrowing money from somebody else, a family member. And the family member didn't want anything to do with it. They wanted to take a passive role and just collect the money. But there was a clear agreement between the two of them that, hey, we're going to do the money, even though it really looked like a loan. That too is a security, which would again need to be registered or fall under an exemption.
All right. So getting back to the joint venture scenario, that's when you're going to have multiple people that are actively participating in the project together. They're managing it. They're making decisions together. It's not just, let's call it the silent partner.
Exactly. If you and I go into a joint venture together and maybe I identify the property and put in some money and you're going to do the active management on it and we're going to meet regularly and discuss it, totally a joint venture, not a security. There's nothing in the securities world about that at all. It's totally fine and normal, happens all the time.
And in my world as a cost segregation professional, doing cost segregation studies for clients, I come across both scenarios where I'm working with clients that are buying property together as a joint venture, or I have clients that are syndicating the deal. They're raising capital, identifying a property, and they're bringing on investors. At what point in the process would you come aboard? When do we contact you and say, hey, we're putting together this Regulation D offering. We need a structure, an entity. Do we bring you on before we've found a project, before we found investors, or after I've got a deal inked and we've got a closing coming up in 60, 90 days?
Most of the time I get brought up when there's a property that's locked up and when there are investors who have expressed interest. So that's probably the majority of the time when I get brought in. I like to get brought in as soon as possible because some of the things we discuss may impact not only the property that's chosen, but also how those initial conversations with investors about what they're looking for and what kind of opportunity they're going to have looks like, right? We may structure it as purely preferred equity or true common equity, or we may structure the waterfalls differently or something based on ferreting out what the best structure looks like. And so the sooner I get brought in, the better. From my point of view, we do unlimited revision. So it's really up to my clients anyway. But I think it makes their job a little bit easier to start having those discussions sooner.
Okay, that makes sense. Just because I'm thinking from my background in the real estate world and mortgage world, as soon as you have that contract, you hit the not the panic button, but let's start moving button. And it's really nice if you have got all the key players in place beforehand and you've already had those conversations as to what's going to happen next.
The restriction is that the syndicator can't take the money until they've got the documents and there's a proper subscription that takes place. And so it takes my firm 2 weeks to generate docs and some other lawyers longer. That eats time before closing, right? Well, we're going to have all the documents done 2 days before close. You're probably not going to make it.
And now once you have that contract and the documents, and you need to request the funds from the investor or investors, are you moving it into, let's say, the escrow account with the attorney's office that's handling the transaction? Or am I pooling the money in a separate escrow account and then bringing it all in at closing? How do you bring in the investor's money so you're not violating any securities laws and you're closing on the transaction in a timely manner?
Nearly always it's moved into the LLC's bank account. So the investment entity's bank account. Personally, my very first deal, I did it with an escrow and I never did again. Wasn't anything wrong with the escrow. It was a very reputable escrow company, but mechanisms in order to get the escrow, in order to release the funds, in order to fund the deal, way more work than was necessary. I already had all my investors who trusted me enough with their $100,000, $200,000, $500,000. I already had their trust in the money, and it was going into an LLC basically with their names on it, right? So they were the owners of the LLC. I was more the manager of the syndication as its sponsor. And the adding of an escrow, in my experience, just adds a complication layer that just even investors don't particularly need or ask for.
So in that case, do you set up these structures, or I'm sure you've seen it, where you've set up the structure and they haven't had a property identified yet, and then they go look to buy a property, or they set up the structure, they bring the money in, the property they identified falls through. The due diligence just doesn't go through. So now you've got that pool of money sitting there. In that case, I guess it depends on the structure itself, whether you would dissolve the entity, release the funds, or if you have a clause in the operating documents that allows you to find other suitable property. Is that something that happens?
Yeah, almost always we'll have something about having a similar property is fine as well. That's nearly always the case. That said, it would be a very bad idea for a sponsor to say, raise $5 million, tell their investors they're going to buy 123 Main Street, have the deal fall out, and then not go to the investors and say, okay, the deal fell out. We'd like to find a new property, but I understand if you want to get your money, because they'd probably lose a lot of that trust if they didn't have that conversation. So even though technically we build it so that they can replace it without any problem, the best thing to do would be always go to the investors and say, look, we had a problem. Here's what we're planning on doing to fix it. Would you like to come along with us? We're hoping it'll be great.
All right. So just to recap that. So the steps are basically you're actively looking for real estate investments. That's part of your world. You're always looking for deals that you want to invest in. You're also always looking for real estate investors who can come into the deals. So those are things that you always have out on your radar. Once you get a property under contract, then you would set up the entity. However, it would be better if you'd already had the conversation before you got the property into contract. So that kind of makes sense as far as putting the steps into place for putting the deal together. Now, with this whole process, am I limited to soliciting investors? Can I put a website up saying, hey, I'm actively looking for investors in car washes that I'm looking to purchase in Tennessee?
So long as the rule that you're putting the offer through allows for solicitation, yes. You can always put out there information. You can talk about investments under Regulation A, which is similar. We oftentimes talk about testing the waters. You can test the waters all you want. You may lose some trust if there isn't an active thing ongoing to find that car wash. Because if you get investors that are really interested and it's okay, we expect to have something in 6 months, you've just lost that investor. They're gone. So you're always balancing that with it as well. But you should be having those conversations about, hey, I've got this opportunities that I'm working on. Is this the kind of thing that you'd be interested in? And if so, great. You take their name and actively work on bringing them in as quickly as you can.
So now that I've identified the investors, because I've been soliciting them, I've been looking for deals, how do I secure the investor? Because finding the deal and getting it under contract is one thing, but having the investor then wire the funds into the entity itself, the LLC, is something different. What do you do to protect yourself as far as, do you request proof of funds from the investor? Do you request a commitment letter, something so that they're less likely to back out? I'd like to thank today's sponsor, CostSeg RX, a cost segregation company. If you're interested in a cost segregation study, log on to realestateexplainer.com and click the cost segregation link at the top of the page.
Most of the time, your preference is to take money up front, right? As soon as there's a subscription, it is in the sponsor's best interest to get the funds earlier. That's not always the case, especially in a pool where we don't know what properties we're going to be buying. And so you may say something like, hey, we're going to buy this kind of property in this kind of location. We haven't found it yet. And so why don't you subscribe for $100,000? And when we find that property, then we're going to call on you to fund it. That definitely happens. It's certainly not like the majority of the time, but a fair number of times you'll do that. The thing for a sponsor to think in mind is you stick as well. If you were to just do that and not have some sort of consequence for funding the deal, at least 50% of the money probably will never come in. Whereas if you have some sort of penalty, hey, we're counting on this money, we're going to take a 10% deposit. At that point, then, okay, they're going to lose money. Even with that kind of penalty, you're still going to collect maybe 90%, not 100%.
The best bet is to have additional funds available if you have investors fall out for whatever reason, and charge a penalty. If you walk from it, you're forfeiting that 10%.
Yeah, it depends also on the investor base, right? If I go to my very best friends and my family, I'm more likely to get it than I'm not, maybe in some cases. But if I'm super close to them, I'm probably more likely to get it than less.
And then what would be the minimum investment that you should consider when you're talking to investors? Let's say it's a smaller deal. You're looking to raise $3 million. You're going to put debt on it. So you're only really looking 30% of that. What would be the minimum that you would want to collect from your investors?
On an individual basis, you'd probably want on the low end, maybe 25,000, something like that, as the lowest threshold. The reason isn't, you can always accept more. You can always accept less. You want to be careful though, because there are costs, not just like paperwork costs, really taxes, but there are costs in just putting the transaction together. There's costs in investor communications. There's costs in your time in doing it. And then just having more investors isn't always a good thing. My worst investor ever invested $5,000. Shouldn't have let them in. Terrible mistake. Where my best investor invested $1 million. Never heard from them. They got a check at the end, wrote me an email saying this was great, thanks. Those sort of things you've got to keep in mind. I'd say 25,000 is the lowest that we see. Probably more common is like 50,000. When you get up in a bigger deal size, something like if you're raising 20 million, you might very well be looking at 150 or 250,000.
All right. And then as far as the investors themselves, do they need to be accredited, or do they have to have some type of minimum net worth or income to step into these deals, to participate?
Sure. That boils down to the rules. So there's two ways to put these offerings together. Under Rule 506B or Rule 506C. Under 506C, that's what we were talking about before, where you can solicit, you can advertise. Everything's great. Now, the caveat there is that you need to make sure every one of your investors is an accredited investor. The other option is Rule 506B. Now, 506B is certainly very powerful and very useful because we don't really need to check on whether somebody is accredited or not. We need to just ask them. All right. We don't need a verification. So it makes the process of funding sooner. We can also take up to 35 non-accredited investors in any 90-day period. The caveat there is that we are not allowed to openly solicit at all. There's no solicitation. And so those people, they're coming from internal networks. So people you already know, already have relationships with.
So you're going to your local RIA, you know a pool of real estate investors that may be interested in the transaction. You can talk to them. But in this scenario, you can't set up a website and solicit to non-accredited investors.
Yeah, it's fine if you're doing a 506C offering. It's fine that non-accredited people see it. You just can't accept them because you need to have that verification of their accredited status.
Okay. So the 506B does allow that. So that's interesting for the smaller deals. Let's say the pool of people that you know in your local RIA or your meetup groups or whatever masterminds you're part of. All of a sudden, this allows you to acquire properties that you otherwise wouldn't be able to acquire just because of the scale. And at the same time, you're able to take advantage of the economies of scale because now instead of buying, let's say, that one single family home, you could buy a 30-unit apartment complex. So you're really bringing down the cost per unit. I just see that there's a ton of opportunities with this structure.
Yeah, absolutely. And most of the time they'll be their family and friends are the people who they're bringing in. And there are people that want to do deals where they want to make accessibility to bigger real estate deals is important to them. And they'll make it accessible to non-accredited investors that are within their network. And we'll put the deals together intentionally under 506B just so that they can fulfill that part of their own personal mission.
And then after the deal is completed, so we're done, we've closed the deal, do you stay on board to provide guidance and maintain the entity structure the long run, or are you done like a closing agent would be done with the transaction? Take maintenance.
I don't stay on as really doing the maintenance. We transfer that part off. What I stay on for is anything that comes up along the way. I'm here for my clients. I've found that 99% of the time when I get called by somebody 2 years after I set them up, that they're probably about to hire me again if they want to talk with me about whatever. And it can be somebody wants to get bought out or somebody wants to do this or they have a sales transaction or whatever it is. So I stay on in that respect. Part of why I structured exactly the way I structured is because I like my clients, right? I like talking with them and I like hearing about their deals and what they're going through. It's part of the thing where it may not ultimately make economic sense because I don't charge for those sort of things, but it makes sense for me as a provider because I get better information about the whole industry. Plus I enjoy it. I like my clients.
Yeah, I understand. And then you just started talking about it. That was going to be my next question was, how do you get out of these deals? How does the exit work? Because a real estate investor is going to want to receive not just their monthly, quarterly, or annual return on investment, but eventually they're going to want their investment back. So are you structuring so that there is a set date at some point in the future, call it 5 years, 10 years, to sell the property, or is it open-ended? How do you get your money back?
There's always a plan. The plan is never exact like a date because real estate never will work that way. You can plan 3 years out, but it's never going to happen. It might be close, but normally we'll say our expectation is to sell the property within 5 years. And then the whole part of the asset manager's job at the same time is always looking at the best use of the asset, right? If that first deal, my expectation was I was going to sell the property in 5 years and it turned out at 2.5. The market was in such a place where it made good sense to get out then, get all the returns we were going to get. We beat the estimate by just a little, which was great. Whereas if we waited, unfortunately, it looks like we wouldn't have made a good deal. But so you're always just looking and trying to figure out, is this the best time to sell or is it the best time to hold? Because it's fine if it goes earlier. No investor is going to be upset because they get their money back sooner and they got a little bit more profit than they thought they were going to get. Whereas if they're in it for too long and it's a sinking ship, yeah, they're not going to be super happy.
Yeah, it makes sense. So if you acquire a property and you're the asset manager, so you're running the transaction and that the value of property has gone up, the value of the deal has gone up to hit that certain threshold, then you can exit. Would you then have a conversation with the investors or would you just pull the trigger? It's written into the contract.
It's written in that I get to make the sole decision, but I don't think that's a good way to do it. I think it's always good to talk to all of the investors, get their opinion. At the end of the day, it's going to be my decision anyway, but I want them to feel heard. And I don't want any investor ever to think that I'm doing it for my own ends or for whatever it is. So I want everybody to feel heard so we can at least have a good discussion and everybody's opinion's been taken into account.
And you want them to bring their pool of investment money back.
I want their next deal. Absolutely.
Making them happy is really key. So it's having the communication, making sure that as the attorney on the front end, you're setting up the contract. And then as the asset manager, it's having the conversations with your investors to make sure that they're happy all the way until they get their money back.
That's why these are so good, right? So if I buy Apple stock today and I have some concerns about the iPhone, whatever number we're on, right? I don't think that release went well. And I don't think your new product lineup's all that good. I can't call Tim Cook up. I will never get him on the phone. Whereas in these real estate syndications, you get to talk to them. You get to get their real opinions. You get to find out. And I think that's powerful. And I think that's why I'm so hard on syndication and funds as a model, because it's truly getting the investor's voice to be able to be heard very easily.
The other cool thing is you have access to other investors and the knowledge that they have because they can talk about other deals they're in. So it opens up this whole pool of potential investments that you would otherwise just not see. So I really do. Now, what happens in the cases, let's say if one of the investors needs to get out of the deal, let's say it's supposed to be 5 years and 2.5 years goes in, something happens in their world, they need their money back. What obligation is it for the asset manager to return the money? Or what opportunities are there for that investor to get their money back?
Yeah. I've never had a deal where this hasn't come up. And I've never had a deal of my own. And I've never had a deal where somebody hasn't wanted to take them out. So it's always worked out good. It's going to happen to every syndicator at some point during their lives, probably quite a bit. And you can certainly define a whole plan and how you're going to do redemptions in the operating agreement. And those work great and fine. I think most common is not really talking about it because the process is always the same. That investor calls up the sponsor. They say, hey, I've had this life event. I need to get my money back. And then the sponsor says either they want to just buy them out right there, or they say, let me put in forward all my other investors and see if anybody wants to negotiate with you and buy you out. Or you can also sell it to yourself if you find somebody who would want to buy your spot. That's totally available. It's almost always the case that there's not an obligation to do it, that it's not promised that, hey, you will be able to redeem in this manner, because that's part of my job to make sure that if you're going to promise something like that, you really know that you're promising to do something like that, because that could catch you off guard.
Yeah, you may need to take a haircut on the deal because the market's down that year. They want to get out. They're not going to get their full investment back. Just like if you were invested in another investment in the stock market. On the other side, if the investment's gone up, they're probably going to make some profit on the sale.
That person's probably never going to force a sale. They're probably in a world where you've got multiple assets. You may, but you never want to prejudice all the other investors because one person has a life event. So we always just try and make sure that the plan is going to be as conveyed to the investor, or that they know there's no right of getting your money back. And we probably will help you. And I've never had a sponsor say, I don't want to give them their money back, because they're all good people. They understand. And most of the time they'll try to make it happen. Sometimes you can't.
Yeah, I think this opportunity or this way to structure entities and bring in outside investment so you can really scale up your real estate investments. It's great. And I'm certainly thankful and grateful that you came on the podcast today. Before we wrap it up, I just want to ask, is there anything that I missed that the listeners should know?
I think in general, syndication, it certainly as you start looking through all the rules, it can get really scary at times. So it's this huge thing that's going to subject you to a lot of liability. And that's my job, is to protect my clients so that the liability risk is very small and that it's a lot of work, but it's not a lot of bad. It's enjoyable. You're talking with people that you like and you're doing deals and everybody's making money. So it's worth, in general, like the whole syndication and funds. If people haven't done it before, it is something to think about as a possible thing to do, because it does work out quite well for everybody most of the time.
And then before we wrap up as well, the listeners want to get in touch with you. What is the best way for them to reach you?
Either on my website, moschettilaw.com, or I've got a YouTube channel with over 100 videos that kind of walks through pretty much any question you might have. And I'm always happy to have conversations with people who are looking to syndicate.
Perfect. Thank you for jumping on the podcast today.
Great. And thank you so much.
If you'd like to get connected with today's guest, log on to realestateexplainer.com and click the Get Connected button on the homepage.